Hey guys, so today we're going to go through a sort of short snippet version of a video which I'm creating for my training course, which is whereabouts should you be looking for to take your profits out of the market. Now this came to me because going back even up to about a year, maybe a year and a half ago, I was still looking at taking retail level profits out of the market. And what I mean by that was looking at your 1 to 2s, your 1 to 3s, maybe even a 1 to 4 if you're lucky, but then exiting my trade. The way which I sort of realized that I could be taking a heck of a lot more out of the market was when I started to look at market structure and really trying to figure out that if I take my profits off at a 1 to 2 or a 1 to 3, the market really doesn't care where I take my money off the table, but it really does matter really how the market truly moves, how the waves of the market move. Now, what we're going to be looking at today is a standard order block structure. Order blocks are what I trade, as well as the London breakout and things like that. But order blocks are generally how I trade the markets. Now, what we're going to do is we're going to go through, I've got a few answers underneath here. First of all, where should you be entering a trade and so on and so forth. But I'm going to work my way through that. And I'm going to draw a little bit to the side just to give you a bit of a demonstration. And then we're going to look at the charts just below. A couple of areas which I've marked out in advance for you. So yes, I've cherry picked a few examples for you to look at, but the principle is very much the same. It doesn't matter which time frame you're looking at. We're just looking at the 4 hour at the moment on the Euro USD. So without further ado, let's just get stuck in. So where should I look to take my profits? Even how should I look to maximize my profits in the market? So first of all, what you need to do is figure out where you are entering your trade at. Now that's going to have a massive impact on the risk reward ratio that you can gather out of the market. If you're entering at an extreme in the market, depends which end of that extreme that you're entering, it can really make a massive difference. Now we're going to get into that in a second. So where are you entering your trade? Okay, so first of all, make sure you are in a discounted area. So this is where we're going to start drawing on the charts. Let's just say that we're in an upward trending market. We all know that the market generally is shaped like this. I know it's very different when you look at the actual charts, but to follow a trending market, we're looking at something like this, okay? We're generating high, higher low, higher high, higher low, higher high, higher low. Now, these lows will quite often dip back quite far in the market. But what I mean by a discounted area, okay, is looking at something like this, for example, okay? So premium versus discount. Premium is basically where price is higher than what you should want to pay for it, and discount is generally a discounted price, okay? If the market is working its way up, it might be even better to place this along here because we're confirming that we're higher highs, higher lows. Discount is where you want to be getting involved, not really in premium. Okay, the premium is the top 50% of a pullback, and discount is the bottom 50%. Now, make sure that you're in a discounted area where you want to be getting involved in the market in the first place. And then secondly, what we're going to see is the extreme order block, if possible. Okay, now in the training course, we go into the different types of order blocks. There's 3 or 4 different types of order blocks that you can be looking at. But we're just going to be looking at the extreme order blocks in this example. Okay, so again, just the idealistic drawing, we're just going to pretend that there's an extreme order block here. This is the extreme order block, and we're looking to enter into the order block if we can, and then continue the market up. Now, what's next? We can drop the time frames to refine our entries. Now, in the examples below, I'm not going to be dropping the time frames. We're just going to be looking at the 4 hours. But what you should be doing is to try and drop your time frames so you can reduce your stop loss, okay? And what I mean by that is, let's say, for example, we get involved on the equilibrium of the 4 hour order block, which we've identified, okay? So let's say we're getting involved in the equilibrium. Our stop loss is going to be, just below the low, and our target is going to be somewhere out in distance. I'm going to show you where to put it in a second. But let's just say our target there is 1 to 8. Superb. That's really good. That's better than most retail trading concepts. But what if we could refine our stop loss a little bit lower? Okay, just make our stop loss just a tiny bit smaller, and we get an entry which just comes in and taps it. We can massively increase our risk reward ratio. Now, our targets don't move. Okay, the targets stay in exactly the same place. Why? Because they're preset targets. We know what we're going to be looking for, and I'm going to show you where to do that. And it's so simple once you get your head around it. And there are a couple of variations that you can do, but there's a very, very simple one that I'm going to give away to you today. Okay, so you can drop your time frames to refine. Then, aim for as little stop loss as possible. So we kind of covered that one just a little bit before. So yeah, you're aiming to reduce your stop loss and make it as small as possible, largely by refining your order block. So let's say, for example, you're identifying an order block on the daily time frame. Price is starting to approach it. You're in a discounted zone. You may be able to drop down to the 4 hour and identify another order block. So the 4 hour order block could be here. Then you could drop down to, say, the 1 hour, and you might be able to refine it a little bit further. Then you drop down to, say, the 15 minute, like, I don't know, something like that. And you should be able to reduce your stop loss considerably more, okay? And hopefully turn that 1 to 8, which we just had, into a 1 to 24, which is very possible. I'll do it on a fairly regular basis. At least once a week, I'll get over a 20R trade. You know, usually daily. You know, the opportunities are there to take it daily. But at least once a week, I'll get a 20R trade. And then what do? The answer for where we're going to be placing our targets. So we've got our entry sorted out, but where are we going to be targeting? Okay, it's really, really simple. It's the end of the previous leg on the time frame the order block was identified. Okay, so let's just say, for argument's sake, that this was the H4. Okay, this was a H4 leg. We've got a low, we got a high, we got a higher low, which was confirmed as soon as we got a break of this high. Okay, so just looking back at market structure, once we got a break, a sustained break of this high, we can say that this is now just the high. The higher high is where price starts to reverse from. Okay, so price is starting to reverse up here. So this is confirmed as the higher high. Then the higher low is confirmed once we start getting a reversal from here. And this low is confirmed once we get a break of this high just here. So we get a break of the high there, and so on and so forth. Okay, so another break will come in there. So if we're looking to get involved on an order block on this leg, what we're looking to do is, 1, it's in the discount zone. 2, price is coming down to a 4 hour order block, which we have refined down to, let's just say, the 15 minute. So we dropped it from the 4 hour to the 1 hour to the maybe 30 minutes and then 15 minutes. We've taken our stop loss from, let's say, I don't know, 37 pips down to, if we can, you know, below 5 if you can. But in this example, it's 13. And we've increased our risk reward ratio from 1 to 8 to 1 to, let's round it up and say 24. Okay. Seems really simple when it's on a, you know, on a fake little chart like this, like I've just drawn. But our target, to make it really, really simple, okay, our target is just, because we're expecting the market to continue, we haven't had a break of this low, we've just tapped into this order block. Our target is just going to be the high of this previous leg. And this previous leg needs to be the 4 hour, because that's what we identified the order block on, okay? So we're expecting the 4 hour chart to continue in its upward swing. Okay, so let's just say, for example, as well, let's clear this off the chart and make it a little bit cleaner. So let's say that we've had a continuation move here, which is superb. And now price has come back up. It's created a new high. So this is the higher low. All what we're doing is we're just marking out where our premium versus discount is. So all what we're doing, as price is reversing its way down, we're not looking to get involved. While price is coming through here, yes, we might get a tap of this. There might be some sort of reaction, most likely. That'll be retail sellers getting out the way and just sort of, you know, exiting their trades or trying to get long and bounce off of this high. Well, all what we're doing is we're just going to wait for the market to come down to the extreme order block, which we're just going to say that we've identified, I don't know, down here, for example. Okay, so we've identified an extreme order block on, say, the 4 hour. But then we're going to refine it again down to, say, let's say that we can just get an entry on the 5 minutes. Let's just say it's that. Okay. Then also we set our targets at the most recent high. Okay. So our original entry is there. Our stop loss is just below the low. And our target is at the high. Really, really simply at the high. Why? Because if it continues beyond that, it means that the market is likely going to continue trending upwards. Not always, but very likely, okay, because we've seen it happen so many times before. And what does the market need to do to continue its trend? Higher highs, higher lows. Really, really simple concept. But what we're doing is we're taking our, you know, 1 to 6.72 and we've refined it down to our little order block. which is now a 9.61. Great. All what we've done is we've got a nicer, cleaner entry. You know, it's just tapped into an extreme order block using a refined section, so a refined time frame, and we're targeting those highs. Okay, so we've increased it from, you know, what, 6 up to 10. Great. So let's have a look on the actual charts to see what we can find. Now I have drawn these out, so it's literally cherry picked, but you can see the concept at the very least. Okay, so here's an example on the Euro USD. A lot of you will be familiar with it. Now this candle over the weekend was a gap. Okay, for some reason Forex.com is showing it not as a gap, but this black candle in particular, this wasn't there. Okay, so the last candle on the Friday, the last 4-hour candle was this little grey push up here. Okay, that grey candle there. This black one wasn't here. So the next day on the weekend, over the weekend, so Sunday night, this little red inside bar formed, and then it worked its way up. I knew, because it was a gap and because the prevailing market was moving downwards, I knew that this was the extreme order block that I wanted to be getting involved in. Okay, so what could we do? We could look to refine and get into a lower time frame. So let's just have a real quick look and see if it worked. Okay, so the 1 hour is still showing that we've got, you know, our initial push up is from this inside bar. The 30-minute is also showing this inside bar as a push up. And the 15-minute is also showing this inside bar as a push up. So I couldn't refine the entry any better than what it currently was. And because it was a gap being filled, now this is just a bit of knowledge which I've got from in the market from experience. Because it's a gap, it normally comes just to tap the gap. Okay, it just fills the gap and off it goes. So what do we do in this instance? Okay, it's nothing magical, nothing spectacular. But we just set our entry at the start of where the gap was, which was the base of that order block. Our stop loss goes at the top, which just happens to be 33 pips, so a large stop loss. And then our target is this low, okay? And the reason for our target being this low is that we're just looking at the lowest point prior to the order block forming, okay? So price had worked its way down, created a bit of a, let's call this a swing in the market. So it's created a bit of a swing. It's pulled back, created this order block, price has worked its way down to here. It didn't break below this swing here, okay? There was no price break below here. So this is going to be the target, okay? This bit is the target. So we set our target on the order block and it's nice and simple, okay? It's a 1 to 4, not incredible, but it's a 1 to 4. What we're gonna do now is we're just gonna go back and look for another one, which I've marked out on the charts previously. So here, okay? The reason why I like this one, okay, I don't think that I traded this one. I think I was on my Forex break, but what we had was a very minor sweep of these highs, okay? The price was clearly working its way down, all right? So price was working its way down in the market for the last few months before. I traded all of this, and then I think I took a break from Forex. I took a break probably around the end of July until the mid-September, or sorry, mid-November. Okay, so this whole gap here, I didn't trade at all. But the reason why I like this on the charts, and the reason why I would have liked it in real life, is that this peak right here is 9091, and the peak over here is 9087. Okay, there's a very, very minor sweep across here to here of liquidity, okay, to continue its journey down. So that means that this is not the order block, because that order block had already had its juice taken out of it by this one. This looked like a very good order block, which would have caught a lot of people out. A lot of people may have had pending orders right here. But you want to wait, ideally, for the market to react. Okay, so if we're looking at market structure, where is the low? Where is the low to continue the trend down? Okay, so we need to look at the low, which is there. Okay, so this low is the low which we need to continue down past to confirm that the market is continuing in a downtrend. Okay, it's not this low, it's not that low, it's not that low, it's none of these little swings, it's this low. Why? Because the market was working its way down, had quite a deep pullback between this leg and this leg, so it had quite a deep pullback, and then it continued its way down. And then it reversed off of this area for whatever reason. There's probably something way back over here. Probably an order block. Yep. So another order block over there. So it's reacted to that. But the issue is that the market is already on its journey down. Okay, you can't disregard the fact that the market is already swinging its way down. Okay, so what we're doing is we're targeting down here. We've already had a little break of liquidity and wick rejections. We've had inside bars. Now, my previous video, which I'll tag somewhere probably up in the top corner, is about inside bars, why I love trading them. Now, what we had here, if we look on a sort of, closer, same time frame, but closer view, is that we've had a miniature break of this structure, okay, only minor structure, but this candle created a low. We broke between this, below this low. So what do? We've got an entry off of this inside bar right here, okay, superb. So this is a 4-hour order block, which I liked. I quite liked this inside bar. Originally, I liked this one, okay, so let's just say it was this one. And then what we did was we refined it and we looked at this order block. And then we refined it again and we've looked at this order block. Now, when you're looking at time frames of 4 hours and 15 minutes, I prefer to get involved on the equilibrium. Okay, so I prefer getting involved on the on the 50% mark. So if we just mark up on our charts where the equilibrium is, it's just on this little red line here. It's quite hard to see because all the colors are pink, but it's just on that red line there. So the equilibrium trade goes on about there. Stop loss goes on there. So a 5 pip stop loss looking at the 4 hour, which is incredible. Okay, so a very, very refined order block. On a lower time frame, you may have even been able to get closer, a little bit closer. Well, obviously a lot closer, probably within 1 pip, perhaps an order block right there. But where's the target going to be? Well, we're looking at the 4 hour time frame, aren't we? So for us to be able to continue the journey down, we've already had a wick rejection of here. It's likely just a liquidity sweep. Would people have got involved? I reckon they probably would have done. And the target is all the way down here. Okay, the target would have been an epic 43.5 to 1 trade. Okay, so imagine doing that with a $100,000 FTMO account. There's pretty much 43% right there, 43 grand in your back pocket. And all you do is you just have to hold your trade down there. Of course, you can't do that on FTMO because you've got to close your trades over the weekend. But if you're holding like a swing trading account, or even if it's your personal account, you can do it. And the same principle applies in most places for order blocks. There's absolutely tons which I'm going past, by the way. Absolutely tons of order blocks. There's loads along here which are the extreme order blocks to get involved in. But I just wanted to show you a few prime examples here. Here's one. So price has probably reacted off another order block. Funny enough, over here. Yeah. So, okay, there's 2 entries. There's 2 opportunities for entry here. Okay, so let's just say, all right, here's a very extreme one, which I didn't actually think of taking before. But here's a very extreme one, which is this. Let's say you get involved on the halfway point of this order block. So the reason why it's this order block is the extreme is that there's no clear order block in this setup over here. All right, liquidity has already been taken from this order block by this candle. And then there's nothing really that clear apart from the wick on there. So this would be classed as the extreme, which is the most prevalent order block available. Now let's say we get involved on the halfway point, which is about there. Stop loss goes down there. And our target, again, is looking at the point between entry and the order block. You look at the lowest point when the market is trending down. The lowest point is here. That's where our target would be. Set your target. 27 to 1. Superb. Okay, so that's a 1 to 27. Also, what we had was after that, let's say, for example, you just missed that trade and you're not really into holding your trades for weeks at a time. Well, what we've had is a reversal. Okay, the markets showed to us that it's looking to reverse. We've had a break of this structure, so really minor. We had a break of this structure to begin with. All right, and then we had a break of this structure, which was the previous low. And then a rejection. Quite often it's just a load of crap. Ignore that rejection once you've already had mitigation of one main order block and indication that the market's going to reverse. So ignore this rejection. These candles don't really matter, but it is indicating that we're starting to head our way down, despite this being an engulfing candle. What do? We look to get involved on the halfway point of the extreme order block. Why is this one the extreme order block and not the last one? Okay, let's have a real quick look at this. This order block, let's say this candle, one, it's not the last candle up necessarily, and two, it's already been mitigated by these two candles here. So that's not the extreme, this is the extreme. So we're getting involved on the halfway point, which is essentially, let's just guesstimate and say it's about there. We got our stop loss there. So bear in mind our stop loss on the other one was 20.2 pips. This one is 10.7. Where's our target? Well, we've identified this on the 4 hour, and our most recent between here and here, okay, not with this one, because this one we were looking at this order block, okay. So a really simple place to be taking profit is just the low here, okay, really simple place. And this is really good if you just want to grab quick profits, okay. There's a 1 to 11, nice and easy. And if you've got the stomach for it, and you know that this one is most likely going to be going down here, what you could do is you could just take partial profits, say you take 50% at this stage or 25%, and you could leave the rest to run. And if you do leave the rest to run down to, where is it, about there, you've got a 1 to 27 and you've got a 1 to 51. Brilliant. Okay, let's do another example. I do have a couple more drawn out. Another one similar to the last one. Okay, price is clearly working its way up. It's come down, it's gone quite deep somewhere. We've had a bit of a mitigation of this. This has mitigated that. There's still a bit of a gap underneath here, and we've got liquidity forming. This is a bit more of an advanced concept, but I don't want to talk about it on this video. But we've had liquidity formed right here. Okay, so chances are there's going to be an order block on a lower time frame right there. So what do? You set your order somewhere around here. Even if price has gone down lower than that, you can set a reverse order, so when price passes back through it, you can take off, okay? So let's just do it on the 50% mark again, and just say that you're going to be doing it as a reverse order. Where's your target going to be? Well, it's going to be nearest high, okay? So it's the highest point between here and here, and that is this one. So once price gets past here, you can take your profits. So there's your target. 6.42. Awesome. Really simple. Okay, and that's just using liquidity in your favor. Let's try and find one more. Okay, so price, this must have been COVID. Yeah, it was, yeah. So this was the COVID announcement. So the market was already working its way down for a number of years. And then we just had this COVID spike. Everybody who trades or has been trading this long will remember this. Massive rally, massive pullback. It's the whipsaw. You know, I've told a lot of people this is the whipsaw effect. Don't worry about it. Price will start going up after that. So what happens? Price comes down, starts working its way up, gets a series of like miniature break of structures. We don't get a break of this high until absolutely ages. But price works its way down, starts mitigating these order blocks left behind. Once we get a clear rejection, okay, so this swept any liquidity. This candle right here swept liquidity from over here. Swept liquidity under here. Then what did we do? We got a break of this miniature structure right here, even though it was just a wick rejection, which I wouldn't worry too much about. And what do we have? A perfect sort of push-up candle here. With these sorts of push-up candles, you can look to enter whichever way you want. But because it's a huge wick, you'd probably want to be targeting just the top of it. If you did just target the top of it, that's fine as well. Okay, so let's say that you got involved on this, just on the entry. You know, all of these entry criteria, you just want to be experimenting yourself. But let's say you got involved on the entry, your target's going to be up here, and it's a 1 to 5, call it a 1 to 5.5, which is great. Alternatively, something that I didn't spot before is the other order block, which is this candle here. You can look to get involved there and take your profit up there. Let's try and find one more. Pretty sure that I marked out another on the chart. Okay, so one more, which is working its way up. The market's clearly on a rally upwards during this time frame. This is what, May 2017, so going back a little bit on the charts. Price has worked its way up, starting to get a little bit choppy. Price comes down, dips straight in, creates an order block right here. And then what does it do? It continues on its journey up. Superb, that's what we want to see. Price is going up. We get another push up again. So we get another break of this structure, bit of a rejection, price comes down, taps this, doesn't quite get a really good entry off of this order block. We don't get a break of anything great, but still it's a valid entry. So what do? We set our entry on the equilibrium or a deeper order block if we can. Get our stop loss on, and all what we can do is we just target here. Okay, just target there. It's a 1 to 10.5. Yes, these are cherry picked, and yes, it's really simple in concept. There's another one over here. All what you'll be doing with this is literally, I hope that I'm just getting the point across with this. Okay, this is just getting the point across. I don't want to give away too much of how I'm getting involved in all of these order blocks, or why. The whole point is just to show you where to target. You're just looking at between the entry and the order block. You want to go for the highest point or the lowest point. Okay, to put it in a sentence. Entry from the order block, highest point or lowest point. And we're just using the extreme order block as the examples on this. Okay, the reason why this is the extreme order block, or this area is the extreme order block, is because from when this high was broken, when we work our way backwards, these are the only order blocks available to us. Okay, they're the only order blocks available, and they are the furthest point between here and here. This is the lowest point. Okay, so on the next leg down, we're looking at this bit. Okay, really simple. Much like when we get a break of this structure, get a break of that structure, the furthest point down between there and there is here. Okay, so our order block is essentially this one of these candles. Okay, it's this candle. This is the order block which we get a tap into. Where you're going to go with a tap in from there, I know an entry from about there, stop loss right there. Target is going to be the high. It's still a 1 to 3. Okay, not incredible, but still that's where you would be targeting. And then shortly after that, price shows a reversal pattern and it starts heading down. So I hope that has made a little bit of sense to everybody watching this. Okay, setting your targets doesn't need to be too difficult. It's literally just a case of following the trends. Higher highs, higher lows. Okay, just remember that. Higher highs, higher lows. Pulling back to a deep extreme order block if you can get it a nice clean setup, and just target those highs. Even if the market wants to reverse, quite often it will just sweep a little bit of liquidity. Let's say the market does reverse from here. Okay, the market might literally just take a bit of liquidity from the top and reverse. But the plus side is you got involved here, you've taken profit at the peak. Doesn't matter if you didn't get in on the reverse, but you've taken your profit, you've got yourself out of the market, and away you go. Okay, simple as that. Now, as I said before, the training course has a lot more detail in this, and we also look at the different types of order blocks where you should be setting your targets, new target concepts as well, so not necessarily always just the highs and the lows. Price does quite often extend beyond, as you can see, and risk mitigation. Okay, so how much you should be leaving on your trade in the event that the price does continue in its direction. And if this has been helpful, please do leave a like, subscribe, give that little bell icon a good old slap, and then be informed as soon as I upload another video to try and help you. So thanks again, and catch you soon.